to share with you some tips for new landlords. Now, you may be a new landlord, firstly because you want to be building up your investment portfolio, or you may have had a change in personal circumstances where the most sensible solution is to rent out your property. This could be moving overseas, moving in with a partner, or you may have bought another property and have to rent your property out just to get the purchase of the new property through. I've got 10 things I want to share with you. So I'll start off with, firstly, make sure you've informed your mortgage company. As a residential property, your mortgage may not give you permission to let out your property. You can find in your mortgage terms and conditions, if you can, you'll have to contact your mortgage company or speak to your mortgage broker about transferring to a different mortgage product. Secondly, you need to change your insurance. Your residential insurance won't cover you for a landlord, and you need to make sure that your buildings are insured as well as your landlord's content. Thirdly, you need to register for self-assessment. You don't necessarily have to where your income is less than £2,500, but we recommend you do, because then your income's formally recorded on a tax return, which will make it easier for you when you need to remortgage the property. Also, if you make any losses, hopefully you won't, but if you do, then it's all recorded and can be rolled forward into your next tax return. Fourthly, open a separate bank account. Again, it isn't necessarily an essential thing that you need to do, but for housekeeping purposes, it's better to have it in a separate pot. It makes it easy for you to complete your information for your tax return. It also makes it easier to maintain the profitability of the property. If you have more than one property, you only need one property bank account. It just makes it clear-cut if things are in different pots. Fifthly, you need to keep all your receipts. So again, it's a legal boring requirement with HMRC, but also it helps you keep track of what you spent and why. 6, what can you offset? Now, the expenses that you can offset are things that relate to the property rental. Now, HMRC's guidance states wholly exclusive and necessarily. So, for example, accountancy fees can be offset, rates can be offset, electricity can be offset, insurance can be offset, legal fees in respect to the tenancy can be offset. If you're in doubt, ask your accountant. That's what you pay them for. Number 7, record your mileage. Now, not a lot of people know this, but if you travel in relation to your rental property, you can claim mileage as an expense. So if you go from home to the letting agency, that's business mileage for the property business. The record you need to keep is the date of the travel, where you're going from and to, and why you're going. The rates you can offset is the miles at 45p for the first 10,000 miles, then 25p thereafter. Next one is whether improvements are an allowable cost. Unfortunately, they're not. So, for example, if a tenant damages a laminate work surface in the kitchen and you replace it with granite, that's not an allowable cost because it's classed as an improvement or an enhancement to the property. If you replace it like for like with a laminate work surface, that's an allowable cost. It's a repair. So when you are doing repair work, just make sure you're replacing like for like. If you do have significant improvements, good news is that can be offset when you sell the property. Number 9 is mortgage interest charges. There's been a real change in how these are taxed over the past few years, and from next tax year, mortgage interest isn't offset as an expense. Now, I'll put the link in the description to my blog post about this, but what's happening is a lot of accidental landlords are getting pushed into the 40% tax bracket. So you're paying 40% tax on your profit before mortgage interest, but only getting 20% interest relief. Now, if you're looking to build up a portfolio, one of the things we look with clients at the moment is putting that portfolio in a limited company so that it protects your basic rate tax banding. And finally, I just want to talk about tax when you sell. We had a client ask this to us this week. Now, when you sell a property you've let out, unfortunately, this is subject to capital gains tax. Basically, you take the profit on the property, less the cost to sell, the cost to buy, and this calculates through to your capital gain. Then if you've rented the property out and you've lived in it at some point, you take the gain from when you originally bought it to when you originally sold it, and you prorata that for the months you've rented. Good news is the last 18 months don't count, and you've also got £12,000 this tax year that's tax-free. So, for example, if you're an accidental landlord and you're in the situation where you've bought another property and you're renting yours out just for the interim to get you through, if you sell your property within 18 months of moving out, then there's no tax to pay on that capital gain. I hope that helps. They're my first few tips for landlords. If you need any help or assistance, give us a shout. But it's just important that you get these things right, and it can seem a bit overwhelming when you first rent out a property. But it can prove really financially beneficial, so good luck with it. Thank you. Bye.